Hey everyone, today we are looking at monetary policy. So, what is it? It's the changing of interest rates by central banks, and that is done in order to influence aggregate demand and therefore achieve our macroeconomic objectives. What are interest rates? Interest rates are the cost of borrowing money and or the reward for saving money. Both definitions are equally correct. The best definition is both, of course. And in Australia, this is all done by the Reserve Bank of Australia. What are the goals of monetary policy? So firstly, we want low and stable inflation. That is the number one goal that they're trying to achieve. So we do this thing called inflation targeting. So you can see inflation in the target. How good's that? And in Australia, our inflation target is to have inflation between 2 and 3%. Now, what they actually look at here is they look at core or underlying inflation, right? So they don't care about that. They do care about it, but they don't target that headline inflation rate. That's the one that gets reported in the news, really. What they really look at is that core or underlying inflation, which strips out the volatile prices of things. And if they want price stability, they aim for that core inflation to be between 2 and 3%. But they also want other things. So they're after helping the economy as a whole. So they want low unemployment as well. They want to reduce business cycle fluctuations. So we want that slow, steady rise in the business cycle. We don't want the big ups and downs because what happens there is that's when people get hurt, right? They lose their jobs and people go through pain. We don't want that. In general, they want a stable economic environment because that is going to be best for everybody. Okay, so how do they do all this? You're going to hear about this thing called the cash rate. So I've included a few screenshots from news sites here to show that this is the language that is used in the news. So cash rate, and these from mainstream news sources, depending on what you think about Sky News. So what is the cash rate? The cash rate is the interest rate that the Reserve Bank sets, and they put that on other commercial banks, right? So it's the rate that banks like Commonwealth, NAB, it's the interest rate that they have to pay to borrow from each other each night. We don't really need to know that detail that well, but just in case you were wondering what the cash rate is, that's what it is. So the banks will pass on this change in cost to their customers. So if we increase the cash rate, that's what's been happening lately. You can see the trend here actually, 4.35%. So that increases the cost of production, the cost of doing business for banks. They pass that on to customers. They increase the interest rates that households and businesses pay. Okay, so how does this affect aggregate demand? Let's just have a look at it. So C, consumption. That is definitely affected here. So if interest rates go up, what's going to happen? The disposable income for mortgage holders will go down. So mortgage holders have to pay extra each month on their mortgage. The interest portion of their mortgage increases. So they have less money to spend on consumption. Therefore, that decreases consumption. Also, if the cost of borrowing money goes up, so let's say you want to buy a car, right? Suddenly, borrowing for that $40,000 car is more expensive, so you're less likely to buy it. So consumption goes down, or you're just going to buy a less expensive car. So still, the result is consumption is lower than what it would otherwise be. There's another side on it too. The return on savings increases because one of the interest rates that gets passed on to consumers is the interest rate we get on our savings. So we get a greater reward for saving, so people are going to save more. So increase in savings, and that means we're reducing our consumption. Right? If we increase our marginal propensity to save, that takes away from our marginal propensity to consume, to use some language from year 11. Okay, and of course interest rates go down, it's the reverse. So we'll just quickly gloss over this. They have more disposable income, they can spend more, right? Mortgage holders have more income, they can spend more. Costs of money, cost of borrowing money more so. If that goes down, people will borrow more, spend more on consumption, therefore it goes up. Return on savings go down, we'll save less, we'll spend more. Okay, then I for investment, right? So these are both factors of aggregate demand. So if interest rates go up, cost of borrowing money for businesses will go up. So, things they might do is they might revamp their kitchen in their restaurant, right? That's one example. You're less likely to do that if the cost is higher. You've got to pay more interest on the loan that you get to do it. So that changes the equation. You might not be viable to do that now. All right, and then of course, if interest rates go down, the cost of borrowing money goes down, you'll invest more, right? Straightforward effects, really. Now, what does expansionary monetary policy look like? This is when we're trying to expand the economy. I've already drawn the LRAS for you. But if you just pause now in your notes, try to draw what that's going to look like, then I'll put it up for you. Okay, here we are. Here's our starting point. Now, if we're going to do expansionary monetary policy, we'd want to be in a recessionary gap, wouldn't we? Otherwise, why would we be doing it? Why would the Reserve Bank be trying to expand the economy if we weren't in what we call an output gap here? So here we are, increase aggregate demand, lower interest rates, increase aggregate demand. This is our result. Contractionary monetary policy. Again, I've put LRAs there. How good am I? Now, why would we do this? We're going to do this when we're in an inflationary gap, right? We want to not necessarily contract the economy. We don't really want GDP to go negative, GDP growth to go negative, but we do want to tap the brakes on the economy, right? So we want to slow down aggregate demand. So we will raise interest rates so people will spend less on consumption and investment. This will be the result. Okay, goals of monetary policy. So we've looked at this, right? How does monetary policy meet these goals? So contractionary monetary policy, right? It's going to weaken inflation. Expansionary monetary policy, it's going to boost inflation. So it depends where we are with inflation as to what our monetary policy is going to be. Remember, this is our number one target, number one goal of monetary policy is that low and stable inflation. So that's largely going to decide whether we're contractionary or expansionary. Another thing that expansionary monetary policy does is should reduce unemployment. More spending equals more production equals more jobs, right? Okay, we want to reduce business cycle fluctuations. How do we do that? We have seen this before when we looked at fiscal policy. So contractionary policy, it wants to smooth out those booms, really, doesn't it? Those peaks, because we just want that slow and steady growth. So it smooths them out by tapping on the brakes, by lifting in interest rates. So it taps on the brakes, imagine a car. And expansionary monetary policy will sort of put the foot on the accelerator a little bit by lowering interest rates. So hopefully we don't go into these recessions, depressions even. We don't want that. Okay, some evaluation of monetary policy. I've seen this woman. This is the governor of the Reserve Bank, the first woman to ever do that. She's been in the job not too long now. Strengths of monetary policy, quick implementation. They meet, the board of the Reserve Bank, they meet on the first Tuesday of every month, and the board meets and they make a decision on monetary policy. They say, are we going to raise interest rates, lower interest rates, or keep them the same as they were? Right, that's what they do. So if something needs to be done, it can be done pretty quickly. They're also incremental, flexible, easily reversible. So if this doesn't really happen, but if they've made the wrong decision one month, they can just reverse it, right? These aren't decisions that are locked in for the long term. So generally, in normal times, the most it will change is by 0.25%. So they can, like I said, they can be changed pretty easily. It's generally considered like it's fine tuning towards macroeconomic objectives. We don't have to announce a big spending package or anything like that. We can just lower interest rates until the conditions say that we should stop lowering them or even raise them. This is a big strength of monetary policy. The central bank of a country, or the Reserve Bank in Australia, is independent. So they are not political at all. So they should be doing things for the good of the economy. This is straight from their website, actually. Policy of the bank is directed to the greatest advantage of the people of Australia. That's a little bit different to how governments operate. Governments sometimes are focused on winning the next election, and they will do policies that have that in mind, whereas the Reserve Bank should be just about what's best for the economy and therefore the people of Australia. Some weaknesses, because there's never any perfect policy. All right, let's draw cost push inflation, also known as stagflation. So see if you can do that. And then what happens? So this is stagflation, right? Decrease in SRS, usually due to it's due to an increase in cost of production. So that's a bit of a problem. We've got higher inflation, we've got lower growth, higher unemployment. That's not a good situation. So remembering that the Reserve Bank's number one goal is to fix inflation, what are they going to do? They could do contractionary monetary policy. That's what they've got. So increase interest rates, get inflation back down. That would be what they want to do. But look what that does. It makes growth worse. It makes unemployment worse. That's not good news. The other thing they could do is fix the growth and unemployment problem if they chose. So they could do expansionary monetary policy and put AD out here. But of course, that just makes inflation worse. So we've got quite a problem. Generally, monetary policy is not really that suitable for supply side issues. It can fix one objective, but not all of them at once. Okay. When we really need to expand the economy, sometimes we have limited scope in reducing interest rates. So this happened 2020, COVID. Confidence just went really low, through the floor, as they say. So Australia, we're down to 0.1% official interest rates. A lot of the economic commentary at the time was that the Reserve Bank didn't have any bullets left in the chamber. So all they've got, their tool, is monetary policy, interest rates, and suddenly they couldn't lower them anymore. Right? So it became less effective. There's also the problem of being ineffective in a deep recession and that is due to expansionary monetary policy really having an indirect effect on aggregate demand. So I should have said on aggregate demand here, because you lower interest rates. So if they lower interest rates, I pay less on my mortgage each month, but that doesn't change aggregate demand unless I spend the money. I have to want to spend the money. But if I'm not very confident, if I think I'm going to lose my job, I'm not going to spend money. If a business thinks they are going to go out of business, they're not going to spend money investing. So when confidence is low, sometimes it just doesn't work. Expansionary monetary policy. Okay, and that is all we need to know about for monetary policy. So make sure you've got good notes, and we'll go through some problems in class. Thanks.